When a headline screams that one of the world's most powerful and wealthy couples, with a net worth exceeding $3 billion, is borrowing $100 million, it's designed to grab attention. The immediate implication for most people is that they're in financial trouble, living beyond their means, or experiencing some sort of cash flow crisis. However, a deeper dive into the financial practices of the ultra-wealthy reveals that this isn't a sign of distress, but rather a calculated, highly strategic move that is a cornerstone of how the super-rich manage and grow their fortunes. The financial strategy of buy, borrow, die approach. The $100 million figure isn't for a single loan, but rather a series of mortgages taken out on their vast real estate portfolio. This includes their $88 million Bel Air mansion, which they initially purchased with cash, and their record-breaking $200 million Malibu compound. The core of their strategy is what financial experts call leveraging assets. Instead of liquidating assets to raise cash, they use them as collateral for loans. Here is a breakdown of the sophisticated logic behind this seemingly counterintuitive move. Tax efficiency and capital gains. This is arguably the most significant reason. When a person sells an asset that has appreciated in value, be it a stock, a business, or a piece of real estate, they are required to pay capital gains tax on the profit. For a property like their Bel Air mansion, which has likely appreciated significantly since their 2017 purchase, selling it would incur a massive tax bill. By borrowing against the property instead of selling it, they access cash without triggering a taxable event. The loan proceeds are not considered income and are therefore not taxed. They get the liquidity they need without giving a portion of their wealth to the government. Maintaining and growing their portfolio. A billionaire's net worth is not sitting in a savings account. It's tied up in a diverse portfolio of assets, business ventures, title, Rock Nation, art collections, and other appreciating properties. By taking out a low-interest loan, they can leave their primary assets untouched, allowing them to continue to appreciate in value. They are essentially using cheap money from a bank to fund new opportunities or projects, while their existing wealth continues to grow in the background, outstripping the cost of the loan's interest. Low interest rate environment and financial arbitrage. The ultra-wealthy have access to private banking divisions and elite lenders who offer preferential, low interest rates. These rates are often far below the average return they can get on their investments. This creates an arbitrage opportunity. They can borrow at a low rate, example, 5% on a jumbo loan, and then invest that money into their businesses or other ventures that yield a higher return, example, 10 to 15% or more. They are essentially making money on the difference. Maintaining financial flexibility, liquidity. Tying up hundreds of millions of dollars in a single asset, like a house, reduces financial flexibility. A large line of credit or a mortgage provides them with liquid cash on demand, allowing them to act quickly on new business opportunities, without having to go through the lengthy and potentially costly process of selling off other assets. It's a strategic move to ensure they have cash available to operate their vast empire. In conclusion, what might sound like a tale of financial hardship is, in fact, a textbook example of sophisticated wealth management. Beyoncé and Jay-Z are not an anomaly. This is a standard, highly effective practice among the world's wealthiest individuals, from Jeff Bezos to Elon Musk. They are using debt not as a last resort, but as a powerful, tax-efficient tool to preserve their existing fortune and create new wealth, solidifying their legacy as not just music icons, but as formidable business moguls.